Is any relief in sight? Let's ask CNBC contributor Adam Parker. He is the founder and CEO of Trivariate Research. He is right here with us on set. Happy New Year.
Happy New Year. Good to
see you. Nice comeback for stocks, although the weakest link, or one of them for certain again, tech.
Yeah.
When's it going to start working again?
You know, I feel like this is going to be a little bit of do the opposite of the consensus. That seems to be the right thing to do. Most investors I've talked to think the market goes lower in the first half of the year, then recovers later. So I wouldn't be surprised if we ended up higher in the first half and then faded later. Why? We talked about it a little bit, I think, last week, just briefly, which is what are the two big barriers to the market? One is the Fed was hawkish, and the other was the earnings estimates were way, way too high. Now the estimates are probably a little bit too high, but the bulk of that downward revision is behind us.
Right.
And maybe the Fed will get a little more hawkish, but they're not going to get incrementally as hawkish as they were from, say, beginning of last year through now.
So, but we're not going to get hit.
Hurdles are
we're not going to get hit with the double tsunami,
right.
But the waves are still big and dangerous.
I just think that the markets are second derivative, not first derivative mechanisms, and that stuff is maybe still declining, but the rate of change is slowing. So I look out and I think, all right, maybe earnings can come down a little bit, but all of a sudden people say, well, I can't own anything that loses money today. I can't own any software companies. You asked about tech? Really? I don't know. A lot of software companies are pretty good productivity enhancing companies.
Like what?
There's tons of them that are in the sort of 3 to 20 billion cap range that are down 80% that will enhance productivity. And so we put out a lot of these idea screens that are names that we think, have some revenue capability. So we'll see. I think this earnings season is going to be great. But if you're saying, Adam, look out in 2023, I'll bet you software outperforms. I'll bet you the software index beats the S&P 500 in 2023. And I think it's because the Fed will start getting less hawkish, maybe even dovish by year end.
Okay.
And that will be good for multiples.
Well, how far
and these businesses can earn.
I'm sorry, how far in advance of that is it safe, quote unquote, to buy some of these names that you think could actually have a good second half? Because, I mean, if you're telling me that everything can have a good second half of the year.
I don't think everything will have a good second half. I think the market will rally some here in the first few months just because, the bulk of the bad news is behind us. So we look out. I wouldn't be surprised if we had a fade. It's really hard to make that double breaking putt. I don't love that. But I would say is software businesses can grow. Businesses that lose money. There's a general view right now, I can't own any companies that lose money. How many reports do you get in your inbox saying, I won't buy a negative free cash flow, I have to buy positive general?
Rightfully so.
We're talking about going forward, not backward, right? We're saying from now for the next year. From now for the next year, do you think there are no businesses today that lose money that will be good ideas to own over 2, 3, 4 years? Of course there will. And so I think maybe now that growth has really lagged. Hyper-growth stocks were down 26% in Q4. The S&P was up 7%. That's not really how risk-on trades work over the medium to long term. So I'm starting to think I got to own some growth. Maybe some of it's going to be software, and that might surprise people, especially when sentiment's low. EV to gross profit, enterprise value to gross profit is the number one valuation metric investors look at for software. The numbers have been reset massively from where we were. And so I just think the risk reward is getting from